to Fast Market here on the Schwab Network. It's time for our cash tag segment. For that, let's bring in Landon Swan. He's a co-founder at LikeFolio. Welcome back to the show, Landon. Happy Friday.
Happy Friday. Good to be here. Thank you.
All right, so we're talking big tech names. Netflix up, 96% from year-ago levels. It's not part of the Magnificent Seven. I don't know why. Maybe it should be. It's had a great run, almost back to all-time highs, over two-year highs. I mean, do you guys have the data that backs it up? It just seems like in the streaming business, when all these other competitors are losing money, they just don't lose money, and they're the leader, and they're going to remain the leader.
They've done a great job. But if you go back, let's rewind a little bit. Look in 2021, the stock's trading at $700, and then it just kind of craters right down to 160, something like that, in May of 22. And now since then, we've almost 4x'd up to the over 600. It's gone on an incredible run. So you look at what happened. What did they do in 2022 to change things around? And a big part of that answer is that they've moved this pivot into the ad-supported tier. And so now you can sign up for Netflix for free. Basically, you pay your time with it when it comes to viewing ads. And it's just been an incredible move for them. So I would not have made that move of CEO. I wouldn't think that $9 or $15 a month would be that impactful for people. But yes, it's done an incredible job. You look at the number of people who are signing up now. You can see that Netflix subscription is up 2%, and the Netflix with ads is up 47%. So they've got a lot of people coming in. And what's great about this is, this is basically a freemium model. Eventually, these customers are going to get to the point, many of them will stay on the ads forever, but many of them are going to get to the point where they fall in love with the Netflix offering, and they're a little bit annoyed with the ads, and they say, you know what, let me pay the 10 or 15 bucks a month and get rid of those. And that's huge. And if they don't pay, Netflix is still making money on the ads. So this was a really big move. I do think that this is the turnaround for Netflix because, again, 160 up to 600 is an incredible move. You got to look at why. Now, when you look at some of the data, one of the things that we look at is happiness. They are trailing HBO Max and Disney Plus, not hugely, but I think they're 64%. Disney is 68 and HBO is 71. So Netflix is down on happiness. That could have something to do with the ads, of course. But when you look at web visits and where they're at in that whole equation, first of all, they've got the majority of the pie, but they're expanding their lead, right? I mean, you look at Hulu, Disney Plus, what they've done over the last little bit when it comes to web visits, they're falling back, and Netflix is expanding. And Netflix currently has, if you look at those three in sort of a pie chart format, who's got the lion's share? Netflix is 2/3 of that, and they're expanding. They've got that plus 5%. So they're doing a great job of taking the lead that they have and expanding it. Now, you start to get into the investor question, and it's obviously it's not quite at all-time highs. It's maybe 15% off of all-time highs, 14%, something like that. But it's on a heck of a run over the last year. And so you start asking yourself, is the valuation, does it make sense? Is this fair? And I would say that it's best in breed. And if you want to own this company long term, buy on dips or sell puts to accumulate shares, whatever you want to do. But I like the company long term. It is a little rich here, but they've shown a good job. They've shown the ability to execute strategic decisions that really make impactful moves for the investors. And so I'm comfortable owning this longer term. I think the price is a little high, but it's still somewhat justified based on their moves.
All right, Landon, let's rewind back to January when Netflix said that Q4 sales had topped $8.83 billion, up 12.5% from a year earlier. And that was the fastest growth. You mentioned 2021, fastest growth from 2021. And I think what was interesting was that ad plan that you talked about was 40% of all Netflix signups in the markets where that plan was available. So we've seen it help with new signups. At what point, though, does that lead to kind of stickiness, especially kind of with the younger segments that have, look, they had to leave their parents' plans, and now they're signing up for this. Do you think that leads to stickiness within these ad subscribers?
Yeah, I think it's actually a good combination between the ad sharing. I'm sure that the account sharing crackdown, the password sharing, and this freemium model, right? So you're kicked off of your friend's account or your parents' account, but the solution is you can still do it for free. And then once you kind of get your life together and you start making some money, and now you're in the working world, okay, I can pay the $10 a month. And so I think it's going to be very good for them. And the data that we're tracking matches up almost exactly. I mean, if you look at people talking about signing up for Netflix, it's up 2% year over year. If you're talking about people talking about signing up for Netflix on the ad supported, it's up 47% year over year. So it's incredible how accurate that data is. So the thing that we're going to be watching right now, I think is critical over the next few quarters, is cancellation engine, which goes right to your question. How sticky is this service? I don't see a lot of people canceling the free version, obviously. It's just what is the conversion rate, and then once converted, what is the cancellation rate or downgrade rate to the free version? So right now, those numbers are fine. There's nothing wrong with them. It's not going up tremendously, very steady. And so I don't have any concerns with that. And I think that the stickiness is going to be the key to this. And from what I can tell early on, the strategy is very sound, and I think it's going to be pretty sticky service.
Yeah, and they talk about saturation here, with the ad tier service that kind of, kept people on their platform, added new members. But at the same time, international growth, Landon, is supposed to be, the bright spot for them as far as continuing adding to that 260 million users. When you look at that, the potential there, that's positive. But then on the flip side, happiness levels, Landon, I know you guys track that stuff. This stuff's got to be blowing everybody else out of the water, because it seems like all the other streaming services just continue to lose money.
Yeah, it's down a little bit on happiness compared to HBO Max and Disney Plus. I think a lot of that has to do with the ads, though. And it's not many points. It's 4 points and 7 points, so it's not too far down. But everything else, though, this is. When you talk about investing, a lot of times you want to, invest when you've got a tailwind, rising tide lifts all ships, and you want best in breed. Well, there's no doubt this is best in breed. I mean, they are dominating the streaming space, and they're doing so in a way. I think this is really important, that you've got to have confidence in the execution of the executive team. You got to know that they're going to make smart moves. And I really want to give kudos to the ad-supported move, because that the investors holding from 700 down to 160, that's painful, right? But to see that turnaround based on a smart decision, that's why the CEOs make the big bucks, right? So I've called into question in the past some CEO moves, and this is one where I'm going to say the opposite. I've got a lot of confidence in this team, and so I like them moving forward. If they had a big shift in that, then maybe not so much. But right now, even though the price is very high, I think it's fair. I would be looking to buy on dips, that kind of thing. I don't think they're going to be screaming to all-time highs over the next month or two. I think you're going to have buying opportunities, but I do think that this valuation right now is somewhat fair, given not only they're leading in the space, they've got the tailwind, but also the execution of the management team.
Real quick here, Landon, before we let you go, sports. They keep on saying we're not going to get into sports, but they've slowly gotten into sports. They got this Tyson fight that's scheduled. Now WWE, the Raw thing's coming on in January 2025. Is that the outlier here for shareholders that, hey, they start getting into the sports end of this thing, that could really boost engagement?
I think so. I think that one's huge. And you've seen if you look at like Fubo stock, you can see what the conglomeration of all the others getting together, what that did. And that's kind of like, is Netflix willing to take on the giant conglomeration of all the others? And if they do, I think that they've got a winning chance, because again, they've got like two-thirds of the mind share right now. Like, everyone uses Netflix. Mm-hmm. So it's not hard to introduce a new service. Whereas if you're a smaller startup and you're trying to compete, it's a lot more difficult. But Netflix, anything that they throw on is going to get eyeballs. So I really think that would be a big win for them if they can get into this space. Yeah. And obviously they have to execute it well. And for the consumer, more competition is great there. So I'm rooting for it for the consumer and as an investor in Netflix.
Yeah, and if they do add any major sports franchises or segments, you're going to pay extra for it anyway. So maybe it's going to be worthwhile for them. All right, great stuff. Great data as always, Landon. Have a great day.
Thanks. Enjoy your weekend.
All right, you too. That's Landon Swan, co-founder at LikeFolio. Joe, let's get into this trade that I came up with, because it kind of fits